The CEO of Winnebago is panicking, and if you own, want, or even dream about an RV, this matters to you. The entire US RVEE market is breaking down from the inside. Canceled orders, falling prices, and dealers desperate to survive. What started with one leaked invoice has turned into a nationwide reckoning, exposing the markups and fake discounts that buyers have been paying for years. But here's the twist. This collapse could actually work in your favor. The question is, will you spot the opportunity before it's gone? The leak that lit the fuse. The panic didn't start in the boardroom. It started with a screenshot. Late one Friday night, a factory invoice from Winnebago's internal billing system leaked onto an RV forum. It showed a 2024 Travato 59K listed to dealers at $126,400. Yet the same VIN appeared online at $149,995. Within hours, users began cross-referencing serials, confirming the impossible. The files were real. By Monday morning, the screenshots had gone viral. Dealers were deleting listings, and corporate communications in Forest City went silent. When CEO Michael Hapa was briefed, insiders say his first words were, "How bad is it?" The answer arrived in the data. Inflated markups, buried holdbacks, and enough margin padding to spark outrage across every state. That night, senior executives locked down email access and issued a containment directive. But it was too late. Investors were already circulating the proof. In a single weekend, trust cracked open like glass, and as the leak burned through the forums, the deeper scandal surfaced. How Winnebago's own system made those numbers possible in the first place. Under the sticker, once the leak spread, journalists and analysts began tracing the paper trail that connected invoice fiction to corporate fact. They found the secret layer, holdbacks, and freight credits buried inside Winnebago's reimbursement contracts. Dealers appeared to pay full invoice, but internal memos revealed quiet refunds of 2 to 3% after each sale. On a single Travato, that meant roughly $3,000 sent back post-sale, a hidden cushion disguised as freight relief. Inside headquarters, panic deepened. Emails from financial officers flagged exposure risk as analysts compared those credits to public pricing. When a CNBC segment cited false transparency, the stock dipped 5% within the hour. Hapa, who only months earlier had promised open book honesty, now faced the opposite reality. His numbers had betrayed his words. Staff described the mood as a pressure cooker. Legal, accounting, and marketing all arguing over who should speak first. By Tuesday, Winnebago's PR department issued a single sentence: "We are reviewing internal documentation." No denial, no control. Silence confirmed what the spreadsheets already proved, and the market responded with fury. That silence wasn't strategy. It was shock. And while the executives argued behind closed doors, the evidence outside was multiplying fast. If you think Winnebago's panic is just beginning, hit like and drop a comment with what you're seeing at your local dealers. Your insight helps reveal how deep this collapse really goes. Asphalt storage. Drive past almost any major dealership in the Midwest during the summer of 2025, and you'll see the aftermath of that illusion. Rows of unsold Class C motorhomes stretch across overflow lots. Fenders nearly touching, grass pushing through the asphalt. Drone footage from Iowa, Indiana, and Florida tells the same story. Hundreds of units parked for months, untouched since delivery. Data from state registration records confirm it. New unit filings are down nearly 20% year over year, while factory shipments keep rising. The result is a swelling inventory glut that looks less like a sales pipeline and more like storage for a company in denial. Each of those idle rigs carries a hidden cost called floor plan interest. Dealers finance inventory through revolving loans, paying interest on every unsold unit. When rates doubled from 4% to 8%, that quiet expense became lethal. A single rig costing $150,000 racks up nearly $1,000 a month in financing charges. Multiply that across 60 or 70 units, and a dealership can bleed $40,000 to $50,000 every month before a sale. That pressure explains the sudden summer clearance ads appearing weeks before normal. What look like generous discounts are really survival tactics to escape compounding interest. Every unsold day adds cost. Every markdown buys time. The pavement outside these showrooms has become the industry's largest open secret. Parking lots filled with evidence that supply has outgrown reality. As lots filled and sales froze, all eyes turned to the one person expected to calm the storm, the man running Winnebago itself. The call from Eden Prairie. Late in August, Winnebago's headquarters in Eden Prairie, Minnesota, held an unscheduled investor call. It wasn't on the public calendar, but word spread among analysts within hours. CEO Michael Hapa's tone was careful, almost strained. He spoke of inventory alignment and temporary production moderation, phrases that sound routine until you compare them with his optimism just 1 quarter earlier. Back then, he'd promised strong consumer momentum into 2025. Now, the script had changed. According to the transcript filed with the Securities and Exchange Commission, Hap admitted that dealer inventory had reached unfavorable levels, forcing the company to adjust throughput. In plain English, they were cutting production. Several analysts pressed him on specifics, how many units, which lines, but answers stayed vague. Still, internal shipment data leaked days later showed output reductions of nearly 15% across key Class C and B models. The call ended without fireworks, but the silence afterward was louder than any statement. Stock tickers dipped within hours, and suppliers quietly began trimming shifts. Behind closed doors, managers briefed teams on operational efficiency initiatives, code for slowdowns. The market finally had confirmation from the top. The Winnebago machine had stalled. The leak had become a signal flare. What started as paperwork on a forum was now a corporate crisis, and the panic spreading through the industry was only beginning. The interest rate guillotine, the panic that started with leaked invoices, soon met a deadlier force: debt. Every dealership across the country carries a silent burden called floor plan financing, the revolving credit line used to stock each RV sitting on display. When interest rates were low, around 4%, that system kept showrooms full and lenders happy. But by mid-2025, rates had surged past 8%, and that quiet expense turned into a guillotine slicing through margins. A leaked Ohio lender memo showed a dealership with 60 units, each averaging $120,000, paying $6,000 monthly in interest. After 6 slow months, costs exceeded $3,000 per unit. Insurance and marketing erased profits, forcing dealers to seek deferments. When debt outpaced sales, everything cracked. And when the credit dried up, desperate owners turned to the last place left to find cash: the auction block. Below cost. The first sign of distress hit the wholesale auctions. Normally, late-model Winnebagos hold firm near invoice value, moving quietly between dealers and rental fleets. But by early September, auction reports from Kansas and Texas showed bids collapsing well below factory cost. A 2023 adventurer with an invoice of $172,000 sold for $154,000 and $18. A 2024 Mini Winnie listed at $104,000 fetched just $92,000. Those numbers weren't mistakes. They were surrender. Dealers flooded auctions hoping to unload units before the next floor plan renewal date, even if it meant taking a loss. One internal dealer bulletin obtained from an Indiana distributor confirmed it, stating, "Immediate incentive applies to all aged inventory over 180 days. Translation: sell now or lose rebate support entirely." Once those clearance units hit the wholesale pipeline, the effect rippled outward. Competing lots had no choice but to follow the new baseline, cutting prices overnight to stay in step with the falling auction floor. Behind closed doors, Winnebago's regional reps begged dealers to protect brand value, but financial survival beat loyalty every time. As those discounts moved from auctions to public listings, the collapse went from hidden to visible, right on every price sheet in America. The price sheet collapse. By mid-autumn, data trackers monitoring national RV listings began flashing red. Within 30 days, the average asking price for new Winnebago Class C models fell from $122,000 to $109,000, a $13,000 drop that shattered seasonal norms. In Ohio, a Solus Pocket once posted at $98,995 appeared in September at $87,900. Arizona dealers cut the View 24D from $171,000 to $158,000. This wasn't marketing, it was capitulation. Analysts reviewing inventory age reports discovered that nearly 40% of listed rigs had sat unsold for more than 90 days. Every passing week eroded profitability, forcing a new round of markdowns. Dealers began calling these motivated listings a euphemism for panic pricing. Winnebago's investor filing soon mirrored the trend. In a mid-quarter update, the company quietly acknowledged retail adjustments impacting revenue recognition. Stock tickers reacted instantly, sliding nearly 12% in a single trading week. The market had finally connected the dots. Inflated inventory plus rising debt equals collapsing margin. Yet even as prices plunged, another storm was building. The long-term damage no markdown could fix. Brand in the wind tunnel. When a brand that built its identity on durability becomes shorthand for depreciation, the fallout reaches far beyond dealer lots. The 2024 Winnebago models now resold at discounts of 15 to 20% within months of purchase. Used listings on national platforms showed nearly new rigs losing between $20,000 and $30,000 in value before their first oil change. That kind of drop doesn't just hurt owners, it scars brand trust for years. Analysts labeled Winnebago's turmoil a credibility crisis, as idle units triggered warranty failures and drained cash already weakened by rebates and interest. Insurers flagged replacement gaps up to 25%. Consumer law groups in Florida and California probed hidden incentives. No lawsuits yet, but panic shifted from showrooms to boardrooms as survival overtook pride. With the financial vice tightening and public trust slipping, the question wasn't if the company would act, but what drastic move would come next. Scissors on the line. By the first week of October, quiet whispers inside Winnebago's assembly plants had turned into open concern. Workers arriving for the morning shift in Forest City found one production line dark, tools stacked, and the shift board blank. A leaked internal memo labeled "Temporary Production Realignment" explained what that meant: a halt on several Class C and B models for inventory correction. Beneath the corporate phrasing was a blunt truth. Orders had stopped. Job postings that once filled the company's recruitment portal vanished overnight. Regional staffing agencies in Iowa and Indiana confirmed suspended contracts affecting hundreds of line technicians. One supervisor's message captured the tone: they're cutting throughput until dealers start calling again. That same week, supplier invoices for fiberglass shells and wiring harnesses dropped by nearly 15%, proving the slowdown wasn't rumor, but policy. Officially, Winnebago called it a seasonal adjustment. Unofficially, insiders described storage yards packed to the fence lines, rows of completed units waiting on delivery slots that never opened. When a manufacturer known for full-capacity pride starts shutting down lines, it signals more than caution. It signals fear of overshoot. And while the plants went silent, another operation began behind the scenes. A quiet deal meant to keep dealers from collapsing entirely. The Dealer Pact. In mid-October, internal bulletins began circulating among regional dealerships marked Confidential Incentive Authorization. They outlined a new rebate program not announced publicly, direct payments to dealers willing to liquidate age 2024 inventory before the next fiscal quarter. The wording was strategic. Participating retailers may qualify for targeted support, but the math told the story. Up to $10,000 per unit, wired post-sale for every model held longer than 180 days. On paper, it was a relief fund. In practice, it was hush money. Dealers who signed agreed to confidentiality clauses preventing disclosure of the rebate source or amount. One manager leaked a screenshot showing the line item "Market Adjustment Credit" buried under administrative reimbursements. It kept retail prices appearing stable while secretly covering dealer losses. The plan worked briefly as sales rose and fall savings ads calmed panic, but each rebate drained cash. Analysts warned half participation could cost $20 million in one quarter. Even insiders admitted the truth. It's triage. We're buying time, not profit. As though those payments drained the coffers, leadership looked for a structural fix, one that could shrink losses without revealing weakness. The Mix Gambit. The fix arrived under a polished name: Product Mix Optimization. Internally, it meant trimming entire trim levels and color options that weren't selling. The goal was to focus production only on high-margin variants that could survive thinner volume. Supplier data obtained from a chassis contractor in Illinois confirmed reductions across 9 model configurations. The entry-level Solis 36B and the compact Revel variant quietly disappeared from order sheets, replaced by limited edition models priced higher but built with fewer parts. Winnebago's pivot to premium trims boosted margins but priced out entry buyers. Rivals like Forest River and Thor copied the move, rebranding higher costs as portfolio focus. An insider admitted, if everyone tightens together, no one takes the blame. Yet fewer options meant slower sales. Profits rose on paper, but consumer trust collapsed in practice. The next time the CEO stepped in front of investors, that gamble had to be justified, and the tone of his voice told everything that spreadsheets couldn't. If this breakdown helped you see the truth behind the panic, make sure to subscribe. The next leak is coming soon, and you'll want to know before prices shift again. The microphone. Late October's investor call began like every quarterly update: polite greetings, optimistic slides, and rehearsed talking points. But the voice of CEO Michael Happ cracked mid-sentence when pressed about dealer incentives. Reporters quoted his reply verbatim: "We are managing through a temporary demand rebalancing period." It was corporate shorthand for "sales are falling faster than expected." When a follow-up question asked if further layoffs were planned, he paused long enough to trigger an audible murmur on the line. Audio of that moment circulated online within hours. Side-by-side transcripts comparing it to his confident April briefing painted a stark contrast. In spring, he spoke of record brand loyalty. Now he emphasized strategic patience and operational flexibility. The markets read between the lines. Winnebago's stock slid nearly 10% before the call even ended. Regulators were listening too. Sources inside the Securities and Exchange Commission confirmed informal inquiries into revenue timing practices, code for checking whether rebates were being counted as discounts or deferred expenses. It wasn't an accusation, but the very idea hinted at pressure building inside the accounting department. By nightfall, clips of Happe's defensive tone filled investor forums. For an industry built on confidence, even hesitation can sound like collapse. The walls of optimism were cracking, and the truth was no longer hiding in leaked memos. It was speaking live, straight into the microphone. The buyer's playbook. When the dust settles, information becomes leverage. Dealers may frame the chaos as recovery, but behind every sale banner sits a spreadsheet of aging inventory. Data pulled from national listings in late October showed that nearly 40% of all Winnebago Class C units had been sitting longer than 90 days. Another 20% were approaching the 120-day threshold, the point where lenders start pressuring for liquidation. That number isn't guesswork. It's the heartbeat of the market. Knowing those cycles means knowing when to strike. Historically, markdowns cluster right before each quarter's floor plan renewal. For 2025, that means early January, late April, late July, and mid-October. Dealers can't hide from interest math. They drop prices because their loans demand it. Shoppers who wait for those windows often save $10,000 to $15,000 per unit without negotiation tricks. A few online communities have begun sharing dealer inventory ages publicly, turning private spreadsheets into open tools. The transparency that started with a leak is becoming a movement. Buyers quietly arming each other with the very data dealerships once guarded. The result is a shift in power, one VIN at a time. But even timing knowledge means little without understanding the next force shaping every future deal: the cost of borrowed money itself. Rates and reality. Interest rates are the invisible hand steering the entire RV collapse. In 2023, average lending rates for motorhomes hovered near 6%. By late 2025, those same loans routinely crossed 9%, with some banks quoting double digits for long-term financing. Federal Reserve meeting minutes from September confirmed that rate cuts were not anticipated in the near term. Translation: high borrowing costs are here to stay. That single variable determines everything. For buyers, it means higher monthly payments that cancel out any headline discount. For dealers, it means carrying costs that multiply every unsold week. And for manufacturers, it means fewer approved loans, shrinking the pool of potential customers. A chart circulated among lenders shows the connection clearly. Each percentage point rise wipes out roughly 50,000 potential buyers nationwide. The next discount wave, therefore, won't be driven by generosity, but by mathematics. Banks are forecasting mild relief by mid-summer of 2026, but until then, inventory must move through lower sticker prices. Analysts predict one more 12 to 15% retail decline before stabilizing. In other words, patience still pays, and the best deal is the one you make after the next quarter turns. While big lenders watch the macro trends, the local reality looks much harsher. Entire dealerships disappearing, swallowed by those who can still breathe under the debt. Winners and exits. The consolidation wave began quietly but spread fast. Bankruptcy filings in 3 states listed RV retailers citing unsustainable floor plan interest. By November, trade associations confirmed at least 20 closures or buyouts involving long-standing family-run dealerships. The survivors are the large network chains, companies with enough credit flexibility to outlast the squeeze. Public mergers and acquisitions reports show at least 6 regional acquisitions since August, with one Arizona group absorbing competitors across 2 neighboring states. Survival now means smaller footprints and online scaling. Independent lots fade as centralized chains take control, cutting service and stock. The same overproduction that sparked the crash is creating monopolies. Analysts warn once inventory stabilizes, these giants will dictate price floors, erasing today's bargaining power. Markdown victories are fleeting. Control, not competition, defines the future. And as consolidation tightens the industry's throat, Winnebago's leadership faces a final decision that could define its fate for years to come. The CEO's last card. Inside Winnebago's headquarters, a new document circulated under the name Winter Continuity Initiative. According to an internal production memo leaked to 2 financial journalists, the plan outlines selective factory reopenings paired with deferred payroll commitments. In plain English, limited restarts funded by delayed wages and supplier credits. The goal is to keep minimal output alive without triggering more layoffs. A financial balancing act designed to appease investors until spring. A quote attributed to CEO Michael Happ reads, "Our obligation is stability, not speed. Yet that stability looks fragile. Deferred pay keeps lights on, but signals survival, not strength." Analysts warn unpaid obligations could outpace sales by March. Employees feel torn, dealers skeptical, and the panic has shifted from rumor to undeniable reckoning. The markets will decide soon enough. The winter quarter is the proving ground, and every corporate promise will either hold or shatter under the weight of its own math. The RV market's changing fast, and this is just the beginning. What are you seeing at your local dealers? Drop a comment, hit subscribe, and stay ahead of the next big shift.